Hello everybody, welcome to a new RRG video which I am recording on Wednesday the 9th of July, and I'm in Amsterdam and it's still before the open of the US markets. What I want to do in this video is take a step back and look at an RRG that shows asset class rotation, take it from a higher level, then do a quick look at what's happening in the sectors, and then go into some factors. I haven't done that much very recently in these videos, but it's a very helpful way, a very helpful RRG to get a feel for which part of the market, small caps, large caps, growth, value, etc., is driving and potentially helping the market go forward, higher or lower. Anyway, that's the plan for today. Let's get started. Here is the RRG that shows the rotation of various asset classes. And just as a quick reminder, these are actually ETFs, except for Bitcoin and the dollar index, that I use to track asset classes. So they are ETFs that track various asset classes. We've got Bitcoin, and I use Bitcoin as a proxy for crypto. SPY, obviously tracking the US stock market. And then we've got high yield, which is an ETF that tracks high yield corporate bond indexes. Dollar USD is the US dollar index. And then we've got the Bloomberg Commodity Index, DJP. And we also have GSG, which is the iShares GSCI Commodity Index. One is more oil related than the others. That's why I have both of them on the chart. And then we've got government bonds, obviously treasury bonds. This is an aggregate of all government bonds in the US, so not separated into various maturities. And then we've got LQD, which is an ETF that tracks investment grade corporate bond index. And the benchmark is VBINX. And VBINX is an ETF that tracks a balanced index fund, which consists of 60% in stocks and 40% in bonds. And the bonds are a combination of government bonds, corporate bonds, and high yield bonds. So this is almost a closed universe in terms of an RRG. The only thing that's not in there is is Bitcoin and commodities and the dollar index, obviously. Anyway, let's look at the chart. And what we see is a extreme outperformance for Bitcoin. So cryptocurrency is still becoming a much more important part of asset allocation. It's here to stay despite whatever people think of it. So we need to keep an eye on it. And I do that through Bitcoin versus the US dollar as a proxy for all other cryptocurrencies that are currently out there. I believe it has now grown to maybe 5,000 already. I don't know, but it's a lot. And then we've got SPY, the stock market, which is inside the leading quadrant, which is good. It means that it is in a relative uptrend versus VBINX, the benchmark that we have here. And the only thing that you see is that the last node is pointing down slightly. The only thing it tells you is that the stock market rally is losing a bit of steam, but it's still up. The relative stock market rally is still up. What's more important is what we see on the other side. So we see the US dollar weakening. That's a story that is ongoing for quite some time already, and that's confirmed here with that long tail pushing into the lagging quadrant on the RRG. And then we have GSG, which is starting to point up a little bit, but inside the lagging quadrant. You got DJP, which is following GSG slightly with a slight delay. And then we've got the three fixed income related asset classes, high yield, corporate bonds, and government bonds, that are all moving lower on the RS ratio scale. The corporate bonds and government bonds are already inside the lagging quadrant, and high yield is following shortly thereafter. It looks almost inevitable that HYG will also move into the lagging quadrant. And what this means in terms of asset allocation is that stocks are the preferred asset class together with Bitcoin, and that there is weakness in all others. And that is an interesting conclusion. Now, let's see if we move this to a slightly shorter time frame. Let's move to the daily RRG. And then you can see a total confirmation of what we just saw on that weekly, because here SPY is almost on the same position as where it is on the weekly chart. But here it's still very clearly on a positive heading, and with the daily moving so nicely into the leading quadrant, it'll be very difficult for the weekly RRG to continue that weakness. So all in all, the stock market, SPY, is the preferred asset class in this universe, probably followed by Bitcoin or crypto in general. But from a portfolio perspective, the weight allocation to stocks is probably, or should probably be, way higher than the allocation to crypto. That's in a balanced proposition, I'm going to say. It'll be very risky to, let's say, put 50% of assets in crypto and not have much diversification. It can work really well, or it can work really bad. And that's something that, a lot of people often oversee, that how important asset allocation, so allocation to various parts of financial markets, is in their portfolio to get a evenly distributed return without many spikes. Well, if that's your goal, of course. Let's take a look at some of the individual charts from this group of securities. Let's start with a look at Bitcoin. I haven't done that in a long time. But what we can see here on this weekly chart is that there is very clearly overhead resistance in the area around 110, 111. Given the history of Bitcoin, breakouts to the upside and to the downside as well are usually the trigger for a rapid, bigger move in the same direction. We have one here, which happened in November 2024, but also here, which happened in October 2023. So I'm going to stick with this relationship, and basically the conclusion is going to be that when Bitcoin breaks or takes out that overhead resistance, there is very likely going to be a acceleration of the move higher. And when we take that to the daily chart, then we got a little bit more granularity, and we see that the overhead resistance area is essentially a range between, let's say, 110 and 112, 110 and 112, and that we've got a little bit of a support area here around 98. And this is going to be very conservative here. When this breaks, when this area breaks, let's say when Bitcoin takes out 112, classical T8 theory tells me that I can project the height of the range. So that's going to be 98 to 110, so 12 to 14K on top of 110, 112. So that's going to be 124 to 120. Let's round it off that the target for Bitcoin would be around 125K if this area of resistance breaks. Looking at bonds, and I'm using the IEF ETF here, which is tracking the 7 to 10 year treasury bonds in the US. It looks as if the range that we have seen, and I'm going to put this at the end of 2023 already, moving sideways, maybe even like starting 2022, moving sideways with a little dip here at the end of 23. That range is now getting narrower, and it seems like some sort of a it doesn't fulfill all the requirements of a proper triangle formation, but it's coiling into those two trend lines. And if we break out of that, let's call it a triangle, we can expect a move in the direction of the breakout. Problem is that this triangle is not forming at the end of a trend, it's not forming at the beginning of a trend, it's not forming in the middle of a trend. So it's forming inside of a trading range, and that makes it a little bit tricky to apply the rules of a triangle here. But at some stage we are going to break out of these two trend lines, and when it happens on the upside, I think that the target area would be around 98, where you see roughly all these peaks. And if we break out on the downside, the target will probably be around 90.90. A bit of a move, but not big. So for the time being, whether IEF stays within this range between 90 and 98 or not, it'll be inside of a trading range. So I don't expect a lot of really trending moves in government bonds, either up or down. And that makes the move of the stock market of SPY really important, because that is going to drive the relationship within asset classes. So here's my chart of SPY. This is the weekly chart. And what you can see is that 2 weeks ago, we actually took out that overhead resistance in the 610, 612 area. And we're holding up pretty well there with a high at 620, 628 last week. So as long as we're holding up here, that means that we're now clearing overhead resistance, freeing the way for further upside movement. It also means that the area around 610 is now a very important support level. As long as that holds, the uptrend in the S&P 500 is confirmed. What you also see is that potential negative divergences are now cleared, both in the MACD as well as in the RSI. We're not overbought. We're not at super high levels in the MACD. So there is all the room to play for within the S&P 500. When I zoom in on the daily chart of SPY, and we can see the break here followed by a good follow through and a bit of a consolidation over the last 2-3 days. Also the support area around 610, I'm going to put it at 610, and we're now at 620. So as long as we now have about 10 points in SPY to sort of correct and digest what's going on. The RSI, it's tempting to, if people want to look for negativity, it's very tempting to call this a negative divergence. I am not in that camp. I think that this was a negative divergence, these two, because they were lower. But that was void and negated when we broke that trend line and went up again. And we also, in between, we went below a 50. So after the divergence, we went below 50. For me, that's a sign that the divergence has done what it has to do, and we're now in a new situation. And the new situation is that the RSI peaked and dropped back and has all the room to go further up. Similarly for the MACD. So all in all, the chart of SPY is totally confirming what you see on the RRG, where SPY is, together with Bitcoin, are the only asset classes inside the leading quadrant and pushing higher.
If you like my videos on RRG and you like to have the same functionality as what I'm using in my videos, you need to get a subscription to Stockcharts.com. It'll open up all the functionalities that I am using in my videos, and it will help you to get a better angle on your holdings and create investment ideas. So if you don't have a subscription yet, get a free trial, and after that, we'd love to see you as a subscriber to our service.
Shifting the attention to the stock market and zooming in on the sector rotation, we're going to bring up the RRG, and first I'm going to do the weekly version of that chart. So the weekly chart, or the weekly RRG for the sectors. And this picture is getting more and more clear, I think. What you see is a nice continuation into the leading quadrant by the technology sector, XLK, and industrials is still inside the leading quadrant, but rotating lower. Nevertheless, it still has the second highest reading in the RS on the RS ratio scale. So these are two very clearly two of the leading sectors, with technology being really strong also given the length of the tail. If we look at the other sectors, I think that consumer discretionary is starting to make a real nice push. It's inside the improving quadrant, but it's now starting to accelerate. The tail is still relatively short when you compare that to technology, for example. But the direction is good, and it's the only sector inside the improving quadrant. Communication services is trying to rotate back up. The last node here is deviating from that trajectory back up, but there's still some room to move higher. If that happens, then communication services will be back inside the leading quadrant and helping the market go higher. Where do we see deterioration? We see it in utilities, we see it in financials, we see it in materials, we see it in real estate, we see it in staples, and healthcare for sure. Energy is starting to improve. But what I read from this is that the more defensive sectors, and at the moment these are utilities and staples, healthcare is way ahead of them, are now starting to deteriorate and rotate out of favor. And when markets rotate out of defensive sectors, that is usually a good thing for the market as a whole. And you see that reflected in the recent improvement for the technology sector, which is very clearly visible, but also, for example, in consumer discretionary. And you can also see how industrials, which is way more of a cyclical sector, is doing really well. If we move this to a daily chart, we can see which sectors are confirming or negating their rotation. You see it's a very different rotational chart. Technology is still on the high end, very low, very short tail on the daily, where we had a very long tail on the weekly. We now have a short tail on the daily. And short tails means a very stable relative uptrend. There's almost no momentum, but a very high RS ratio. So that means that that relative trend is trending upward at the same speed. Because remember, momentum measures increase or decrease in speed. If you have a straight line up, the momentum will be almost zero because it is going up at the same rate of change. That's why momentum sometimes is called rate of change. Communication services at almost the same position as on the weekly, so the same story goes there. You see the improvement for energy starting to pick up, but it's way on the low end for on the weekly scale, on the weekly chart, to become really interesting at the moment. But what I see here is materials and industrials starting, to come back to the leading quadrant, and that can be helpful. It's a bit of a bummer that financials are rotating out because they are on the high end of the spectrum. And it's also too bad that consumer discretionary seems to be rotating out of favor because they were starting to do so nicely on that weekly RRG. What we do see here is utilities and staples moving further down, and so is real estate. And that is the confirmation that investors are rotating out of defensive sectors, putting more emphasis, more power into the cyclical sectors. Looking at some of the individual charts, starting with XLK technology, we can clearly see the breakout here above 240 and the acceleration after that. Very clearly breaking the relative strength out of its falling channel and pulling the RRG lines higher. Now, this has been a pretty significant rally already, but the fact that we cleared that overhead resistance gives us good support on the downside, so it's lowering the risk. And I wasn't sure, that wasn't very clear until we started breaking first this gap and then now this overhead resistance, which is now starting to act as support. This was helpful, and as you can see, the technology sector historically has been at way higher relative strength, RS ratio levels than we are now. Doesn't mean that we can't go down, but there is clearly much more upside from a relative perspective, and I think that is important. Looking at communication services, we see kind of a similar picture where we broke overhead resistance, we're following through, and this area here around 105 should now start to act as support in case of a decline. From a relative perspective, I'm not super happy with this area here where this seems to start breaking, and you can see how the RS ratio line was already pulled lower, momentum started to pick up, but this could be a deal breaker here where relative strength is starting to move more sideways or even down. So for the time being, communication services is definitely still one of the stronger sectors, but I'm going to keep a close eye on this relative strength development because it could push it out of favor in terms of relatives. Industrials is doing really well after the break, and it's still continuing at, it's the highest levels at the end of the bar for each week. The relative strength line after breaking this downtrend, this downtrending resistance line, is now starting to move back up, and that eventually this will definitely help the RRG lines to curl back up again, or probably better to say to have momentum curl back up and continue the push of RS ratio higher. So industrials definitely one of the better sectors at the moment. And then the last sector chart I want to look at is for financials, XLF. And the break is there, but we're dropping back, and we're now back into the old resistance area, which now should start acting as support. So very important that we can hold in this area here. We could even stretch it a little bit to 51.77 is the high on the week of May 19. So that is stretching it. More importantly, we're breaking this uptrend in relative strength, and that is taking its toll on the RRG lines, and it's pushing the financials, pushing XLF into the lagging quadrant. And that is a bit of a bummer because I am not sure whether this will be turned around very soon. Sorry, one more chart, not financials, the last one. Consumer discretionary, we need to look at that because this is the up and coming sector. You can see that it hasn't broken to new all-time highs yet. It was underperforming SPY for quite some time, but you can now see the improvement. Relative strength is moving sideways. That means that RRG lines are starting to pick up. But the catalyst, the trigger, will probably come from this break here. You saw that 2 weeks ago, we saw the break. Last week was kind of a pullback, and now the market has just opened about 20 minutes ago. You can see that we're now starting to move higher again, and that is interesting because it looks as if that support level held and that there is now plenty of upside for XLY to move to the 230, 235 area, and that will definitely pull up relative strength versus the S&P 500. And as promised, I want to finish this video with a look at factors, size and growth value, pretty much. And that's also a pre-defined group in the drop-down, growth value size. I use that a lot because you can play around with it. I'm going to try to show you what I mean. So here you see all these factors listed on an RRG. You can already, by just eyeballing it, see that growth and large cap are, now in the leading quadrant and leading the market. Let me highlight a few things. So first of all, the growth versus value rotation. So here you see growth and value isolated out of this group, and there's a very clear rotation going on into growth stocks out of value stocks. So that is a pretty important observation, I'm going to say. When we switch those to large, mid, and small caps, and we got large cap, we got small cap, and we got mid cap. And what you see here is, I'm going to blow this up. This is interesting because large cap is very close to the benchmark, which is the Dow Jones US index. It's the entire market. Obviously, the large cap is a big portion, so large cap is usually always a lot closer to the benchmark than all the others. But more importantly, we see the heading of the large cap group pushing towards the leading quadrant. What's also interesting is see that the mid caps are now being rotated out and small caps are also picking up. Usually you see large cap moving one way and mid and small the other way, but now we actually have mid and small using or rotating at opposite directions and being the market. So the message that we see here is if you want to go to the extremes, a move out of mid caps into small caps. And if I try to make a rational reason about it, small caps are usually a little bit more riskier investments because they get hurt easily, but they also have a lot of potential. So the move of investors out of mid cap into small caps could be translated as a move to more risk on investments, to more riskier stocks, because small caps are usually riskier stocks than large caps. Now, and if I'm going to take those off, and I'm only going to do the breakdown, so we've got mid cap growth, we've got large cap growth, and we've got small cap growth, and now we've got large cap value, mid cap value, and small cap value. Those are the other ones. And then you can see a much better picture here. And what you can see is that value mid cap and value large are definitely rotating out of favor. Value small caps are picking up. And you can see how large cap growth, small cap growth, and mid cap growth rotating out, but still at a very high reading. but the rotation is out of mid and large value into large cap growth and small cap growth, and to a lesser extent into small cap value. So combining these two, I think that the improvement is very clearly in the small cap section here. So we've got small cap value and small cap growth. And then obviously there is large cap growth, which is basically driving the market, because that's in theory like the S&P 500. Anyway, I hope this makes a little bit of sense. So if I recap it, then we see from an asset allocation point of view, very clear preference for stocks now. Within the stock market, you can see a very clear preference for large cap growth and small caps in general, both small cap growth and small cap value. And then from a sector perspective, technology remains very strong together with industrials, and communication services needs to up its game in the next couple of weeks. All in all, the wild sector rotation that we saw over the last couple of months seems to have settled down. We now see a rotation more towards growth and cyclical stocks, and that explains or confirms the strength of the S&P 500, as well as the move to large cap growth and small cap stocks. Thanks for watching, and I'm looking forward to seeing you again at a new video on RRG and relative strength very soon.